Hey everyone, welcome back to the Weekend Charts. Charlie Bilello here. As always, I'm going to take you on a tour of markets and run through the most important charts and themes that I'm seeing today. You have to start out with the mortgage market. 8% mortgage rates in the US for the first time since 2000. That's according to Mortgage News Daily. And it's been an incredible turn of events here. We have the lowest mortgage rates in history in early 2021, so below 3% mortgage rates back then. And fast forward to today, we're over 5% higher at 8%. So over 2 decades since we've seen an 8% mortgage rate in the US. And what impact is this having on the housing market? It's having an enormous impact, of course, because most people finance the cost of a home. And if we look at home builder sentiment, it's going back down in a rapid fashion. This is the housing market index, down sharply for the second month in a row. And now more builders are viewing conditions as poor than as good. There had been a brief period where this had been moving higher a few months ago, but now rapidly moving lower. And I think, of course, 8% mortgage rates being the number one reason why. And in that report, in terms of the housing market index, 62% of builders are now offering sales incentives. That's the highest level of the cycle. So they have to offer these incentives in order to sell these homes because homes are increasingly becoming unaffordable. So probably no surprise that these builders are becoming less excited about building new homes, and therefore housing starts are moving down. 7% decline year over year, 25% from the peak back in 2022. So if we're looking at the home construction ETF here, we had talked about it moving higher because there was more confidence and people were expecting housing activity to pick up again because of that confidence. And that really hasn't transpired whatsoever. So very quickly, we're seeing a repricing here, a very quick 20% decline for this ETF in a few months. Still up on the year, which is kind of remarkable given what's going on in the housing market, but certainly very different than a few months ago. And so you see this happen all the time where expectations are wrong and the market is wrong. So the market was saying that we're going to see more building from these home builders. That hasn't happened. And now we're seeing the adjustment in terms of price. So let's talk about existing home sales here. This was an unbelievable report that we got from last month. It showed the lowest rate of sales of existing homes since 2010. And the unbelievable thing was that it was actually lower than the COVID lows in terms of the number of sales. So during the COVID lows, we had a 4 million seasonally adjusted annual rate, and today we're at just below that. So, put simply, almost no sales activities going on compared to where we were a few years ago. Just very few homes are for sale, and they're selling at a lower pace than they have since 2010. And if we look at this year as a whole, if we're looking at 2023, it's on pace actually to have the lowest level of home sales in terms of existing homes since 2008 at just over 4 million. Now, one might think that because sales are down and because demand has gone down so much, that prices would have come down as well, but that simply hasn't been the case. And because prices haven't come down and mortgage rates have gone up so much, well, we have many Americans that are priced out of the American dream, which of course is to be able to afford and own a home. And for a long time, that American dream was based on your level of income. Home prices have a very high correlation historically with people's incomes. And we saw that diverge 2 times in history, one during the housing bubble of the early to mid 2000s. Then we saw a quick correction where it brought homes back down to affordable levels. And the second time would be today, where not only are home prices stretched regardless of mortgage rates, but now we have mortgage rates up at 8%, really compounding that. So you have high prices and high mortgage rates, which is leading to lower affordability. And the remarkable thing, though, is we're not seeing home prices come down to adjust to those levels. So this is a chart showing you the median asking price of homes for sale in the US, and it's actually 5% higher today than it was a year ago, which is pretty remarkable given how much demand has come down, which means that supply has come down even more than that collapse in demand. And so far, that's keeping prices elevated. And what that means for the average person who's looking to buy a home, well, they need to have a higher income today than ever before. 115,000 is the median household income now needed in the US to afford the median priced home, and that's significantly higher than where it was a few years ago. In August 2020, 3 years ago, we're looking at 75,000, and today we're at 115,000. That's a 53% increase in just 3 years. And why did it go up so much? Two reasons. One, home prices went up significantly since August 2020, and two, mortgage rates are, of course, much, much higher today. And the problem is that this 115,000 that you need to afford the median priced home is much higher than what people are actually earning. So if we look at that median household income in the US, we're at 75,000. So we're about $40,000 below what the median household would need to afford that median priced home, which basically means that housing is unaffordable to most households in America at current prices and current mortgage rates. And at some point, there needs to be an adjustment. The question is, what's going to happen first? We're going to see prices come down, we're going to see mortgage rates come down, or is this going to just be a long period where incomes have to rise in order for housing to become more affordable again? So one of those three obviously is going to play out, but in the short run, it's really the housing market in a standstill. And until something changes in terms of these factors, it seems to be continued standstill is expected. So what are higher interest rates having on, what impact are they having on the bond market? Well, we've talked about a lost decade for stocks before. From 2000 to 2010 might seem impossible given the gains for the stock market in the last decade, but stocks actually went down. The S&P 500 was actually down over that 10-year period. And what we've seen in the last 10 years, stocks have done incredibly well, but long-term bonds now are actually have a lost decade. They're actually having negative total return, so including those interest payments over the last 10 years. So this is the TLT 20 plus year treasury ETF now with a negative return over the last 10 years. And there's the S&P 500 up 191% over the last decade. So very good decade for stocks, terrible decade for bonds. And the last 3 years have really been the reason for that. So before that, bonds were doing incredibly well. We had, of course, the all-time low in interest rates in 2020, and this 20 plus year treasury bond ETF was on fire and massive inflows were coming into it. But the problem, as we said back then, was that that had pulled forward years, and now we're seeing perhaps even a decade of returns to that very short period of time. And the consequences of interest rates moving higher from those historic lows have led to the longest and deepest bear market for bonds in history. And we could see that here in the 10-year treasury bond annual returns here, three consecutive. If it holds here, we're down 5% so far this year. If this holds, it'll be the third consecutive down year for the 10-year treasury bond. We've never seen that before in history. And more important than just being down 3 years is the magnitude here. If we combine these 3 years together, we look at a cumulative return, you're looking at a loss of over 26%, which is by far the worst 3-year loss in history. In fact, only one other period actually had a down 3-year period, and that was 1978 through 1980, and it was only down 3% cumulatively. So this is far, far greater, of course, in terms of magnitude than back then. And in terms of how we got here, in terms of interest rates, how do we have this situation where bonds are down 3 years in a row? Well, we started out in 2020. We ended that year with a 10-year at 93 basis points. 2021, that moved up to 1.5%. Last year was the killer, went up to almost 3.9%. And today we're closing in on 5% for the 10-year treasury. So that increase in interest rates from a record low here at the end of 2020 to where it is today has led to the worst and longest bear market in history. That's the past, of course. What's going to happen in the future? Well, most likely you're going to have a much better next 7 years for the bond market simply because yields are much higher today. And in terms of predicting the future for the stock market, we could never produce a chart like this. It would be nearly impossible if you looked at any factor to predict anything with a correlation this high. So we have a 97% correlation between the starting 10-year treasury yield and the future 7-year bond returns, annualized returns. And historically, when we've had returns around 5%, for the starting yields in terms of the 10-year, you're looking at around 5% per year returns going forward. And this doesn't tell you anything about what will happen in the next few months. Interest rates and their direction are going to dictate all of the movement in the short run. So if the 10-year goes to 5.5%, you're going to see, of course, continued declines. If it goes to 4.5%, you're going to see some gains, of course. But over that full 7-year period, the most important factor is going to be that beginning yield. And why returns have been so bad over the last 7 years is because 7 years ago, there was very little yield in the bond market. And today, we're at a much better place. If you're coming into the bond market today, your expectations should be higher in terms of future returns than at any point since 2007. So let's talk about the yield curve and what's going on there. We're seeing a bear steepener, which means that long-term yields are rising faster than short-term yields. So we're seeing this inverted yield curve become less inverted here. So we're at negative 16 basis points in terms of the inversion today, where 10-year yield still below the 2-year yield, but becoming less inverted each and every day, and pretty rapid move in terms of the steepening over the last month. Now, what typically happens before a recession? We're going to talk a little bit about the yield curve and its predictive power in terms of recessions in the next segment. But what do you typically see in terms of recessions, in terms of the type of steepening? Do you see this bear steepener during right before recessions? No. What you tend to see is the opposite. You tend to see a steepening, but you tend to see a bull steepening where the 2-year yield is actually moving down at a faster pace than the 10-year yield. So both of them are moving down during that steepening, but you see the 2-year moving down at a more rapid pace, and that's because the expectation is the Fed is going to start cutting interest rates, and that 2-year yield is reflecting that more than the 10-year. So if we look at, for example, here during the 2020 recession, you can see both of the yields moving down very quickly, but that short-term yield really collapsing here. And we saw the yield curve steepening ahead of that. And then you have the 2008, 2009 recession. You can see similar thing here. Yields kind of peak out. And in late 2007, the Fed starts cutting interest rates. And then they cut interest rates very rapidly in 2008. And you can see that 2-year yield coming down much quicker than the 10-year, even though both were coming down, and the yield curve steepening as a result. And then before the 2001 recession, similar thing. Fed starts cutting rates in January 2001, and you see that 2-year yield come down pretty rapidly, much faster than the 10-year yield, leading to that steepening. So in terms of signaling power, if you're waiting for that clear indication that a recession is coming closer, well, it would probably be the opposite in terms of behavior. We'd probably start to see both of these yields stop going up, and we'd start to see at least that 2-year yield start to move down pretty rapidly on the expectation that the Fed is going to start cutting rates. And right now, the market isn't there in terms of that expectation, but that could change, of course, very quickly. What the bond market is saying today is that the Fed is going to start cutting rates in the middle of 2024, but those expectations can change. So be on the lookout for that type of behavior. It's interesting to see that this steepening is going on. A lot of people talk about inverted yield curve as a recession predictor. It's a pretty good predictor, but it's a long leading predictor. It's actually when the yield curve is no longer inverted, when you're talking about right before the recession occurs, the yield curve starts to steepen and is not actually inverted anymore because the Fed is aggressively cutting interest rates. And let's talk about that inversion. And what I like to look at is the spread between 10-year and 2-year yields. And it's still inverted, but like the 10-2 spread is becoming much less inverted today. But now it's actually been a full year since it first inverted. So actually last October, we saw this relationship go negative for the first time in a few years. And what we said at that point in time is that's not an imminent indicator of a recession. And it tends to take quite a while before this first inversion occurs and a recession to begin. And there's a lot of variability around that. So this doesn't have predictive power in terms of saying when is a recession going to occur. But what we have seen and ahead of all of the recent recessions is this yield curve invert before that recession. The average lead time has been around 24 months, but we've certainly seen shorter. We've seen as short as 11 months. The last cycle was 12 months, but every cycle is different. So a lot of people are saying this yield curve inversion no longer works. It's invalid because we're not seeing the economy yet in a recession. And the pushback to that should simply be it's too early to say that because we're not even at the average lead time. So if we saw a recession in 2024, this would be well within the historical ranges in terms of its predictive power before the start of a recession. And last point on the inversion here, a lot of people have asked me is, have we ever been inverted for this long before in history? The answer is yes, but only 2 times. This is now the third longest inversion. We had an inversion in the early 1980s that was longer, and actually in the mid to late 1960s. But other than those two, this is the longest. And if we were to stay inverted for another 4 months, it would be the longest inversion in history. We'll see if that happens. As we said, it seems to be steepening pretty rapidly here, but we'll see if that continues. So in terms of the yield curve, don't count it out just yet. Hopefully it's wrong here. We don't have a recession, but it's too early to say that. And those long and variable lags in terms of Fed policy and the impact that it has on the economy, I think we're just starting to see that. We'll talk about that in this next section. So in terms of predicting recessions, the yield curve is an indicator, but it doesn't tell you when. And I think that's an important point. And I think looking at the leading economic index, yield curve is one of the indicators there. This should tell you how difficult it is in terms of predicting recessions. Even when you put together all these leading indicators as the conference board has done, it doesn't tell you when a recession is going to start. So now we have this leading economic index down 18 months in a row. That's the longest streak since 2007 to 2009. So starting last year, the conference board who puts out this index started calling for a recession. First, they said the recession was going to begin near the end of last year. Then they shifted, saying it was going to start in the first quarter of 2023. When that didn't happen, they said second quarter, then the third quarter, then the fourth quarter. And now, in their most recent update, they're now projecting a recession to begin sometime in the first half of 2024. So at some point they will be right if they keep pushing this out or pushing it out again. But it shows you the difficulty of pinpointing it. Using these leading indicators may tell you that there's an increased probability of a recession happening at some point in the next few years, but it certainly doesn't tell you that it's going to start the next quarter or even the quarter after. And if we look at the third quarter numbers and we look at the Atlanta Fed that does their GDP now expectation, well, that remains pretty high. So I think it's a pretty good signal to say that recession did not begin in the third quarter as the conference board was previously predicting. And the Fed is estimating over 5%, the Atlanta Fed, in terms of this GDP now. That could change. But what's interesting is the blue chip consensus, which is just averaging 10 Wall Street firms, has now continues to push up and is now above 3% as well. So the expectation is pretty high, I think, heading into that report. Does this mean anything in terms of a recession can't start next year? Certainly not. But for now, U.S. economy still in expansion. So let's talk about some of the earnings reports. We have Netflix report this week. Pretty good report. And pretty big turnaround for Netflix from where we were a year ago. A lot of pessimism a year ago for Netflix, and they seem to have turned things around for now. If you look at revenue growth, close to 8% year over year, and revenue actually hit a new quarterly high of $8.5 billion, and they're forecasting another high for the fourth quarter, and they're forecasting that year over year increase to go back into double digits, which has been kind of the norm for Netflix throughout its history. It's had a few difficult times, but last year we saw the slowest revenue growth for Netflix ever at just under 2%. And in terms of net income, big increase, 20% year over year, and getting closer to that peak in net income, which was in the first quarter of 2021. I think the biggest news for Netflix was in terms of subscriber growth, outpaced expectations by over 3 million. So they added 8.8 million subscribers versus 5.5 million estimate. And if you look at Netflix subscribers over time, you can see here, this is a phenomenal growth story. Of course, in 2003, 20 years ago, they had 1.5 million subscribers. Today, 247 million, and that year over year subscriber growth now is in double digit territory. Once again, up 11% year over year. So in terms of the stock price, Netflix had been going down previous to the report. Expectations were probably pretty low, and the stock bounced so far on the news of that earnings. So Netflix first to report. Tesla came shortly after them. Tesla was a different story in terms of its fundamentals moving in the opposite direction. It had revenue growth move down to 9%. That was the slowest year over year revenue growth for Tesla since Q2 2020. Net income went down 44% for Tesla at 1.85 billion. And the big reason driving that, of course, was this margin compression. We've been talking all year about Tesla cutting prices on its vehicles. Well, it's translating into much lower margins. Gross margins 17.9% in the third quarter versus over 25% a year ago. And what Elon Musk emphasized during the call was the challenging environment, particularly with interest rates, in terms of how that's curbing demand and making cars less affordable. Most people, over 80% of people, finance the cost of a new car, and interest rates have been moving up pretty rapidly. 8.3% the average new car loan rate for a 48-month loan, and that's significantly over 2.5% higher than just a year ago. And we're coming from around 4% before the Fed started hiking interest rates. And so the reaction, as you might expect, was not very good in terms of Tesla. Tesla had gone up significantly heading into the report year to date. It's more than doubled. So this is obviously worse than expected. And I think the concern is that Tesla is sacrificing income, sacrificing margins in order to maintain its sales. So if Tesla is having this difficulty in terms of maintaining the amount of sales, even though it's cutting prices, you would expect other car makers that haven't cut prices as much. If we look at Ford and GM, when they report, you would expect that the declines to be even more dramatic and hit them more. And what Musk has emphasized here, and it'll take time to tell whether he's right or wrong to make this assessment, but what he wants to do is sell as many Teslas as possible and just have more Teslas on the road, and then they'll monetize that years to come if they have to. So in the short term, sacrificing profits. In the long term, he wants to have more market share. And what he emphasized is they're going to find a way to try to cut costs to make cars more affordable. Given this loan dynamic, they can't change that, but they can try to change the cost of production. And they've already rapidly reduced that this year, according to their reports. But their goal is to continue to do that to make these cars more affordable. But it shows you that long and variable lag in terms of Fed policy. Well, it's definitely having an impact on the housing market and the car market. Any area where financing is a big part of it is obviously going to be hit hard by these huge increases in interest rates. So I want to talk about now what's priced in. And this often comes up when you're looking at an individual stock. People will say, well, that news is priced in, or that isn't priced in. And they'll also say things like, well, it's already reflecting that. The market knows what's going to happen. The market is always right. Don't question the market. And I want to show you this chart as an example that it's never that simple in terms of figuring out what's priced in. And the market is often very wrong. So if we look at Moderna, December 2020, the FDA issues emergency use authorization for their COVID vaccine. And at the time, the stock was doing, of course, incredibly well at that point in 2020 and better than most stocks out there. And people were saying the good news is priced in. The expectation is that sales are going to explode higher, profits are going to go up, and all of that's priced in because the stock has moved up so much already. And lo and behold, that wasn't the case. Moderna stock continued to go up in 2021. It actually tripled from that standpoint in December 2020 from the point where they authorized that vaccine. So they did not anticipate that happening at the time. It wasn't priced into the stock. And then you get to that August 2021 peak, and people are saying things like, well, this is going to continue to be a growth story for years to come. The market is right. Look at the price action. It's extremely bullish. It's extremely positive. And lo and behold, the market is not always right. The market's often wrong, and it's most wrong at the extremes when expectations are very high or very low. And for Moderna in August 2021, they were extremely, extremely high in terms of expectations for the future. Those expectations have not been met. Growth has slowed significantly. And now we've seen an over 80% decline in Moderna stock price since then. It's now at the lowest level since November 2020, actually below where it was when that emergency use authorization was issued back in December 2020. So the lesson here, very clear. Be careful when anyone's telling you they know for sure what's priced in, and be careful when people say things like the market is always right. Don't question what the market is saying. So next topic here is this what a bull market looks like? And what I'm asking here is simply, do you tend to see in a new bull market small caps underperforming to this large of an extent? And a year ago in October, we had the S&P 500 bottom. We had an enormous rally after that. Everyone got excited about that. And in July, people were saying it's a new bull market. We're only a few percent off of the January 2022 high, and we're going to get there. It's a new bull market. And since then, we've had a little bit of a pullback, but the strongest stocks in the market remain these big large cap tech stocks, and it's really been holding up the indices. We have the S&P 50, so the 50 largest stocks in the S&P up 24% still year to date. But meanwhile, if we look at the equal weight index, down 1%, small caps down 3.5%. And if we look at compared to the lows from last year, the rally in small caps not nearly as big as in large caps. And you don't tend to see that off of a low in terms of if that was the bear market low, you don't tend to see that type of weak advance. Oftentimes you see small caps really lead that advance and explode higher. We're not seeing that here right now. Perhaps that'll shift. But for now, this is kind of a question. Is this what a new bull market looks like? And I would say we don't know for sure that that October low is the low. People are saying, well, you don't usually have rallies last this long. Well, every time is different in the market, and this will be no exception to that rule. This could be the time where we see this long rally and then the market goes back down. And I think why people are so optimistic in terms of saying that this is a new bull market is that simply they haven't seen a bear market last any lengthy period of time in such a long time that their base case expectation is we're just going to go back to a new high. And this chart really tells that story here. We've hit a new all-time high for the S&P 500 every single year since 2013. So 2014, 2015, 16, 17, 18, 19, 20, 20, 21, and early 2022, we hit an all-time high. And this year so far, we haven't seen any. And so people are saying, well, we're just going to run back up and the long bull market's going to continue here. But if you look back historically, you can see that we can go a few years without hitting all-time high in the S&P 500. That wouldn't be that unusual in a historical basis. And I'm not saying that's going to happen this time around. Maybe it will, maybe it won't, but that is one possibility that people aren't considering, that perhaps that bear market is not over and this is just a long rally within that. And I think the weakness in the average stock is really the most concerning thing if you're looking in terms of kind of questioning that rally off of the low. So I want to talk about the Treasury Department, and I'm wondering what they're trying to hide because they haven't issued this monthly Treasury statement that they're supposed to issue on the 8th business day of every month. And like clockwork, it comes out on that 8th business day. And this time around, October 12th, over a week ago, it just never came out. And I clicked on it and it said delayed, and that was it. There was no explanation. And now it's been over a week, and they haven't said anything about why it's delayed, when it's going to come out, what's the reason for that. And the concerning thing is this is the report where they're showing you the actual numbers, where they're showing you what are we spending it on, and how much are we taking in terms of tax revenue, and what is the deficit. And we know the deficit is massive. We know we're borrowing way more than we're taking in, but why is it so bad that they can't show us it anymore? If it is, that's a real problem. So hopefully they'll release this at some point. And if anyone knows why they haven't released it yet, I'd love to know. So send that over to me. But looking at the national debt here, every single day it's hitting a new high. And I think we're becoming kind of desensitized to it. But this is a remarkable increase that we're seeing here. It doesn't seem to be slowing down. And the last thing that I saw today is Biden's asking for another 100 billion. And he's got a number of things he wants to spend that on. But I think we're becoming less and less sensitive to these numbers. Like 100 billion used to be a lot of money, and today it's like nothing. Another 100 billion, sure, why not? We're already 33 trillion in debt. What's another 100 billion between friends? And fewer people are questioning, where is it actually going? What's going to be the long-term consequences to all of this spending? And it's just, we'll worry about that later. So I think there's too much detachment from that outcome, and because we're not raising tax revenue, we're not the cost isn't being felt today. We're not increasing people's taxes to pay for things. We're just borrowing money, and we're saying let the next generation worry about paying it back. That's not a good thing. And unfortunately, I think it has to get closer and closer to a crisis before we start taking this seriously. So I want to end with something positive, some good signs on the inflation front. And I want to start out by talking about used cars. So we get this Manheim used car index. They just gave their latest mid-month update for October, and it was at its lowest level since March 2021. And we've talked about used car prices and just the ridiculous increases that we saw now finally starting to come back down here. These are wholesale used car prices, which are a leading indicator of retail prices. So over the next few months, we should see retail prices start to come down. Hopefully they come down in a meaningful way. And we've talked about Tesla prices coming down, but it would be great to see other prices coming down in a similar fashion. Number two is this Freightos Baltic Index. So it's measuring global container freight rates. So simply the cost of shipping, and the cost of shipping skyrocketed during COVID and stayed elevated. And then it started to come back down last year. And now we're at levels that we haven't seen since 2018. And this is very good news. It means that the supply chain issues that the people have been talking about ad nauseum for a long time, well, they've in large part been alleviated, and this should be helpful in terms of inflation. If we look at import prices in the US, we've seen this translated into lower prices on a year-over-year basis for a number of months now. So hopefully that continues as well. And finally, on the inflation front, we got that tick up in terms of CPI to 3.7%. But I think the good news here is looking at real-time inflation data. We have this Trueflation, looks at a lot of different factors, a lot of different inputs, and they're saying their real-time inflation rate is around 2.2%. And my expectation is that the CPI will come back down next month and probably be around 3.4 or maybe even 3.3%. So overall, good news on the inflation front that we're not seeing a continued move higher, and perhaps we'll stay below 4%. Hopefully, the next big number that we cross will be back below 3%. So with that, we'll end it right there. Covered a lot of ground today. Thanks everyone for joining me. If you like the content, as always, hit that subscribe button for more content just like it. Have a great weekend, everyone. Thanks for joining me, and we'll see you next time on the Week in Charts.